My name is Rob Giles, and I am a real estate broker with the Corcoran Group here in Manhattan. And we represent buyers, sellers, and renters in Manhattan, Brooklyn, Queens. Corcoran's a very large, excuse me, sorry. Thank you. We represent buyers, sellers, and renters in Manhattan. The only time that I work with family offices is generally with the second and third generations to help them buy apartments in New York City. Sometimes it feels like buying a Major League Baseball team. It's a lot of a challenge, but it's very different than what you all do. So what I'd like you to do is just introduce yourself. We'll start with Andrew and tell us a little bit about what you focus on, and then we'll move on to Matthew.
Great. Thank you. My name is Andy Weiss. My company is Sapphire Capital Group, and I have a commercial real estate advisory firm based in Bethesda, Maryland. And we take on assignments to raise debt, equity, and ground lease capital for commercial real estate deals. I've personally been working in the commercial real estate finance field my entire career, 30 plus years. I've been a lender, a private equity investor, worked for a retail shopping center REIT, and I've been in and out of mortgage banking my whole career.
Thank you. Okay, Matthew.
Hey, how are you? Good morning, everybody.
Good.
I'm Matthew Kessler. I'm here in Los Angeles. I work for Pace Equity. Pace Equity is a leading property assessed clean energy company. We are a balance sheet lender of commercial real estate development projects in the U.S. Pace Equity is a very creative way to add capital to your capital stack and boost your ROI. Pace Equity financing can be used for, new construction, retrofits, mid-construction, cost overruns, completed projects, working capital, cash out. Pace Equity, as a balance sheet lender, currently we're about $1.3 billion in dry capital. So we're extremely knowledgeable, not only in the ability to work inside of a capital structure for a commercial real estate project, but there are 37 PACE approved states in the United States. And again, PACE stands for Property Assessed Clean Energy, and it's a public-private partnership which creates a new financing option. So for myself and my own background, I've been in real estate for about 40 years. I've worked for Guggenheim, I've worked for BlackRock, I've worked for UBS, all on the family office fundraising side, as well as working inside of the capital structure of a family office, making sure that their asset allocation to real estate was correct and, abundant enough to make sure that they get the returns that they're looking for. So my role, I think today, is to make sure that not only do I represent the family offices and how I see them in real estate, but more importantly, to make sure that we have a really good take on the commercial real estate environment. And I look forward to contributing. So thank you.
Fantastic. So let's dig into it. We've heard a lot about the current interest rate environment. We've heard about banks failing and the pullback in lending. And, I feel it here in Manhattan. It's really tough to get lenders to, they've been creating a lot of problems for me. Tell me a little bit about what your take is on commercial real estate in general. Comment about where we are now and maybe where we are going in the next 3 to 5 years.
Absolutely. So, today I put up some numbers. We've got the prime at at 825, the 10-year treasuries at 376. And lumber prices at about 351 per 1,000 feet. The interest rate environment is set. There isn't going to be a lot of movement in the commercial real estate environment. Pace Equity, we price all of our money off the 10-year treasury. So if the 10-year treasury, is in the mid threes, we add 350 to it, and that's our rate. So we know we're going to be a 7 handle when we lend money. We also realize that the commercial real estate environment is looking for capital. They're looking for dry powder. They're searching private equity. They're searching hedge funds. They're searching investment groups. So capital is the big constraint to growth right now that we're seeing in commercial real estate. Other things to be thinking about is the real estate predictions. I mean, it's very hard to figure out where the markets are going. In one of our pre-calls to get this group together, we were discussing, where in the United States commercial real estate is going to be best. Well, it used to be that you would just put a smile on the United States And those would be the key markets from San Francisco to LA to Houston to Miami to New York. Well, two of those markets have blown up. New York is 50% see-through leasing. San Francisco is going through tremendous problem with deeds being handed back to lenders, as well as keys being left on the floor. So there's a new look in terms of how real estate is going to be used in the commercial side. And family offices just have to position themselves properly with a really good advisor, a good investment management firm in real estate to put their portfolio in order for the next 15 to 20 years. Because as we know, commercial real estate, if that's going into a family office portfolio, is looking out to generation two, generation three. They're not thinking the next 5 to 7 years. It's a 15 to 25-year hold. So we think if you're properly positioned in commercial real estate, keeping your debt down and your loans long term, and your financing abilities there, we should be in great shape going forward.
So Matthew, can you just comment on see-through leasing and what that means? I've never heard the term.
See-through leasing, it just means that the building is 50% unoccupied. So when you look in the windows, you can see from one side to the other.
I like that. Okay.
That's a new one on me.
So Andrew, would you like to comment a little bit about where we are and where we're going?
Sure.
Anything you want to comment about see-through leasing?
No, I had heard that term before. I have viewed some see-through buildings in my career. So I'm just going to take a step back for a minute. So sort of set the stage, as I basically thought of three different areas to talk about, a little bit of a recap of where we are, which I'll do it quick because we've covered it. Maybe like a short sentence on each property type. And then I put together, what I think are, three different opportunities for family office investors that I touched that I thought would be relevant to the audience. So everyone
let's talk about opportunities. Yes.
Right. Everyone knows, with the rise in rates, with the pullback and what's happened in the banking industry, that resulted in a dramatic decrease in investment sales. So a lot of the volume in real estate transactions comes from investment sales. Not all of it, some of it is refinancing, but with the huge decrease in investment sales, and why is that? It's because, rates have gone up. And what a seller was looking for, back in beginning of COVID when rates were so low, doesn't work anymore, and the buyers can't pay that amount because most buyers are financing their purchases. So that's resulted in investment sales just plummeting. On the property types, office properties have probably suffered the most, as a result of COVID and this new trend of people working remotely. Multifamily suffered a little bit in COVID with people, with what happened in COVID, but in general, multifamily has rebounded in most markets. Retail properties had suffered a little bit, pre-COVID with online sales, a lot of problems with malls, but in general, retail has now recovered in most markets. Similar with hospitality. Hospitality, again, pre-COVID had some rough years. But got hurt again in COVID with no travel. But now, both business travel is up, leisure travel is up, and the hospitality industry is doing well again. And industrial sector is really hot, and that has a lot to do with supply chain, last mile warehouses. So quick recap on the properties. So to me, here are three different opportunities that I've been involved with that I thought would be interesting for for family office investors. First is sort of, and I give one example of a niche strategy. So a recent deal I closed was so many people have been looking at multifamily. I've done a lot in multifamily. It's been obviously, a safer property type, but hard to buy multifamily now because of debt rates. So I had a client looking for student housing projects that for one reason or another didn't do well in COVID. A lot of decrease in people needing to live on campus. And they were able to acquire a student housing project in a Southeast market where the seller, couldn't make it work. It happened to be a good market for multifamily. So they were able to identify a property that they could buy at a good basis in a location that works for multifamily, buy the student housing and convert it from being leased per bed to being leased per unit. And when you do that, a couple of things happen. Leasing per bed is really a gross lease. Multifamily leasing per unit is a net lease. So, one, they bought it at a good basis, and two, they were able to make a big improvement on the operating expense pass through for the landlord. So that's one example. Second example is something called ground lease capital. And there's a lot of negatives and a lot of people probably in the audience that have had bad situations with ground lease capital, but sort of just like CMBS, ground lease capital, I'll call it 2.0. There was a public company called Safehold that came out. They were affiliated with iStar, and they started doing ground lease capital probably 2016, 2017. In simple English, what it means is splitting the capital stack for a real estate deal into the lower risk, maybe the bottom 30 or 40% of a capital stack. That's just going to be buying the dirt, enter into a 99-year ground lease, but doing it in a proper way that it will work for the different parties. So that means, having a year 1 ground rent, a small little, let's say 2% annual escalation, and then in some cases a repurchase option, which is something that I spent a lot of time on. So the buyer of the property can say, okay, I'm going to take 30 or 40% of my capital stack, lock in lower cost of capital, and then they go finance the leasehold side. So I throw that out there as for an investor who's looking to preserve their capital, and he's most interested in principal preservation and wants a fair yield that's going to escalate each year so that gets some inflation hedge. Ground lease capital can be great, and we've done a lot of that. And what it doesn't have, which some of the old ground leases have, are things like a reappraisal of the land in some arbitrary year. A reappraisal of the land in year 40 is the problem. The ground leases that are being done now, and what I'm calling ground lease 2.0, they don't have any problems like that. They're just, a fixed income investment. And obviously the biggest thing is, I didn't say yet, was it's an unsubordinated ground lease. So if the ground lease goes into default, the purchaser of the dirt takes the land and the improvements back. So it's a very safe position for an investor to invest in the senior unsubordinated ground lease. And then the third theme, which is going to be popular for the next several years, is what I'm calling cash and refinances. There's an enormous amount of debt out there in commercial real estate that's going to be coming due. And when the deal was initiated, whether let's say it's either a construction loan or someone acquiring a property like a multifamily, what we call value add property, someone's acquiring a multifamily property with a bridge loan. They plan to buy the property, renovate it, raise the NOI, and then refinance it. Well, a lot of those deals were done on floating rates. SOFR, or the old LIBOR, was at 0. Now it's at 5. So when these loans come due, in the olden days, it would always be a cash out refinance where you would take money out non-recourse. Now it's going to be the cash in refinance. And why I'm mentioning this is for a family office investor, if you're looking at a good sponsor with a good property in a good location, there's going to be lots of borrowers out there that are going to have loans coming due that need an injection of capital. And you can put it in as preferred equity. There's lots of different ways to structure it, but that's a theme that I believe will be very popular for the next several years. So again, I can stop there, but those to me were a couple examples of opportunities for private investors to invest in real estate.
Excellent. So thank you. So Andrew, we had talked about different concepts. What about inflation and some of the economics that are affecting us? The question that I wanted to ask you is, will inflation affect rent and expense growth through the next cycle? And will it be enough to negate the cap rate compression that's occurring? And how will we deal with that going forward?
I feel like I want to call David Walker back on that one, but
yeah, well, I don't want it to be about the Armageddon that's happening, but I want it to be about where, how do we deal with that? And, how would you deal with it? And how would you recommend a family office address it?
Yeah, listen,
I've why don't we talk?
I'll give you an answer. I've always preferred, I started my career working for Prudential, and I used to do long-term 20 or 30-year fixed rate loans. And I did construction perms and I did long-term perms. So one way is for the capital stack, if you lock in fixed rate debt, then you're taking whatever it's So let's say, it used to be always 75%, loan to value. So if you're locking in the majority of your capital stack with fixed rate debt, then the property owner is going to get the advantage of inflation, things like multifamily, self-storage, the property types where you're rolling your rents constantly, you should be getting increased rents with inflation. And the way to protect yourself is to have fixed rate debt. In the last couple of years, one of the problems has been with SOFR going up and floating rate debt going up. The only really solution to protect yourself on that was interest rate caps. And I remember, I think it was 2021-ish, 2021, when people were anticipating rates going up, the interest rate caps just became extremely expensive, and it's hard to protect on your debt costs going up. I don't know, Marty, Matthew, if you want to add to that, but that's,
Yeah, I'd like to hear from Matthew, his comments on that, and we'll move on to that.
Sure, absolutely. So, just some points. Andrew, you're talking about, fixed rate debt. Ace Equity, who I work for, we are a fixed rate debt house. Our debt is 30 years. We are non-recourse, and we're 350 basis points over the 10-year treasury. So a lot of family offices have been contacting us as rates are rising, wanting to lock in now a property where they can purchase long-term fixed rate non-recourse because they believe, as we all do, that inflation is moving up. So we've been seeing a tremendous amount of volume in our loan portfolio. The other thing that you mentioned was, the economic data. So just some points. Durable good orders were up. When durable good orders are up, so is inflation. New housing starts up another 12% this month. So when housing starts up, they're going to be looking for capital. So if it's a new housing start, if it's a development, was it built to rent or was it built to be sold? Those are two very different asset classes that we're seeing family offices take a look at. And the third that we're starting to see is master developments. We're also seeing a lot of action in the master development area where 200, 300 acres in Florida or in Texas are being gobbled up. And again, either built to rent or built to sold. But more importantly, they're putting all the amenities inside the community. So we're seeing a lot of action in those two areas. And then also we look at, the prime rate. The prime today is still at 8.25, hasn't moved. Rates are going to remain where they are. Fed isn't going to be making too many difficult decisions going forward. We are moving into an election season. So that's why we agree with you, Andrew, that, locking in a long-term rate now is probably a very good idea as you go forward and you're building your portfolio for a family office.
Thank you. So I want to talk a little bit about my favorite topic, which is residential real estate, housing. It seems like let's say it's a warm spot. It's one of the areas that family offices seem to trust. Why can't I find inventory, and where do you see things going as far as new development and the financing aspect of that and construction costs? I mean, that's a big thing we haven't talked about.
Yeah, I mean, the biggest problem out there is that nobody's selling. If nobody's selling, you have no inventory. I live here in Los Angeles and I'm frequently in New York. It's the same problem. If you're not selling, there's no inventory. If you're not building new inventory, your prices are going up. So we're starting to see this over and over again through lots of different cities in the US. As I mentioned earlier, the master plan communities is just a way to work. In California, you can't find 200 acres to build 50, 60, 70, 80 houses. It's just not available. But if you move to Southern Florida in the Fort Myers area and the St. Pete area, and you go into the Tampa area, master plan communities are absolutely happening. And then the idea of just, going out and finding money. Banks have taken risk off the table. And when banks take risk off the table, they take their money off the table. And when they take their money off the table, just as we saw with Silicon Bank and Signature Bank and others that have either been gobbled up or absorbed recently, they were bankers to the high net worth individuals who were buying these properties. That line of credit has gone away. JP Morgan, as you know, bought one of those banks. So we're seeing it very, bottom up economy, where only the wealthy at the moment have the ability to go in and finance because they're paying cash. So it's becoming very tricky to grow the real estate market throughout the US on a home level. We don't deal in homes. We're a commercial real estate lender. So I think on the home market, they're facing a lot of big headwinds.
Thank you.
Yeah, I guess I can add
Would
a
you like to
couple
comment?
things.
Yeah.
Yeah, a couple things. So not to restate what Matthew said, but for new construction rental apartments, it's very hard right now for all the obvious reasons. Banks have cut back, so loan to value, loan to cost in general is dramatically lower. So where you could have gotten at the peak, 70, 75% well-priced senior construction debt, now you're more in the 55% range. And you're at a higher rate. So they require a lot more equity. And most of the institutional equity is literally sitting on the sidelines right now. I've worked on a couple ground up multifamily deals that were fully entitled, in good locations, ready to go. And simply with no other change of lower leverage, higher cost of debt makes it a little bit risky for the equity investor to jump in when they don't know if rates are going to keep going up. So obviously, a lot of cutback in new construction starts on multifamily. Flipping that around, lots of people in life have been contrarian, and if you are able to finance your pre-development costs all cash, or you are a major equity player, or an investor that wants to get in with a qualified sponsor, because of the lack of new starts that are happening now, you fast forward 18 months. And there's going to be a lot less new supply coming online. But again, I'm caveating that to say the reality is you're really going to have to do that with a lot more equity. And it doesn't make sense to be locking up deals. Some debt funds that are still active right now are making construction loans at double-digit rates. And really, when you look at that, not that I have anything against the debt funds, but they're setting themselves up for a problem. Because when those properties deliver, they're going to be sitting on a lot of debt, and it's going to be hard. It's going to be back to what I said before. It's going to be back to a cash in refinance. If you finance a construction project with a debt fund, and the debt fund is starting with a double-digit rate, when that loan comes due, it's going to be a cash in refinance because you're not going to be able to finance that out, and that's going to be a problem.
Yeah, I'm going to have to pick up on that. I'm going to agree with you. I'm just thinking about our own, dry powder. We're sitting on about $1.3 billion of dry powder now for loans. We're going off at about a 7 handle to about an 8 handle on our rates fixed 30 years. But those that are working with the debt funds, they're just going to have to refinance, Andrew, in 3 to 5 years. We don't know where rates are going to be in 3 to 5 years. And you're right, it's going to be very difficult. And then the appraisal value becomes so important in a property when you're refinancing, because everybody, bases their rates and their values of how much money they're going to give you off the appraisal numbers. So if the markets are tight, values keep going up, sure, you'll be able to go back into the market and you'll be able to borrow again. The debt funds are getting 11 and 12 and 13% rates because there's nowhere else to turn if you have large construction projects. The projects that are 5 to 25, there's capital available. But the larger projects at 50 and above, it becomes very tricky to get a deal done, whether it's New York, Memphis, Chicago, or LA. So I have to agree with you on that one.
And I can give you one more different answer on a different niche is home building. So I don't spend a lot of time on it, but I have a few clients that buy land, get the land entitled, and typically sell the lots to home builders. And so I know I have friends that do that have made a lot of money. And the phrase is always, it's perfect until rates go up and the music stops. And that's what's happened in the last year. I know a couple people that have had, well-located land parcels of land. And when I say well-located, I live in the DC area, so I'll use my market near employment centers. So in Northern Virginia, maybe near Dulles Airport, areas where maybe in Arlington, Virginia, where, Amazon, second headquarters is. So that's a great business, buying the dirt. And what they typically can do is they can buy the dirt. They know how much it's going to cost to get the entitlements done, put in the water and sewer, put in all the infrastructure for the home builder, and they do what's called a pre-sale. They go under contract with a home builder that puts up a non-refundable deposit to take down lots. That's a great business model until rates go up. The home builder says, you know what? it's no longer working and they decide to default on their contract, and then the gentleman that bought the dirt is in trouble. So I've seen that in this last phase of interest rates going up. I've seen a lot of well-located parcels where the home builders have decided not to move forward, and then you have a problem.
I have a quick question. I just want to interrupt, as I usually do. So it's not just the issue that banks are having problems. Isn't a lot of this a risk management issue? Whereas people who were putting out loans before could afford defaults at lower rates that you can't afford at higher rates, right? Because your capital efficiency has to be so much greater when the rates are higher. I mean, it seems to me that there's risk management involved. Matt,
Oh,
I mean, you're like the expert because
absolutely.
you have been in this space for 20 plus years, and you're a young guy, right? So
Right. Right. So again, to tell you what I said earlier, risk is off the table. It used to be that banks, Signature Bank or, Silicon Valley Bank, they were lending to wealthy investors, wealthy individuals, throughout the United States at 3 and 4%. Those numbers are just unheard of. Until those banks got closed down, their leverage was out of order, and the amount of capital they had to back those loans were out of order. With those banks gone, that wealthy market that loved to get 3 and 4% loans, that's gone. Now they're going to have to move up to 6, 7, and 8% type loans with the rest of the U.S. Something else that I think that people should be aware of, and again, just a program that we have at Pace, is that, Andrew, you're talking about, fixing today's rates and you're in and maybe the rates are too high. We allow you to refinance on a project 3 years post your certificate of occupancy. So if you built a property and you're now 3 years in and you'd like to refinance that property with all of your construction costs, show us your construction costs. Dollar for dollar, we will reimburse that property for all construction costs to help you lower your mortgage, because you just pay it off. So we just did a project recently in the Midwest. We were able to supply them with about $6 million worth of retrofit, going backwards 3 years from CO. They took the $6 million and just paid down their loan, or they could take the $6 million and buy another property. So there are ways to help yourself as a family office who's looking to figure out what is the best place for asset allocation. And let's take that one step forward, because I think this is a really important topic, and Andrew, you can chime in, but I think the asset allocation of what types of property should go in a portfolio today for a family office that's, long-term is really significant. I mean, we have office, industrial, storage, hospitality, multifamily, retail. There's just so many places to go. And I really believe that, industrial and storage and multifamily are the 3 top places for long-term good rates of return. So back to you, Marty.
Yeah, so no, well, Marty, I'm gonna answer the question again from another view. So I'm not gonna repeat risk, but I'm gonna say, let's take banks as an example. Your question had to do with, are lenders pulling back because of risk? So I'm gonna say, if I take banks as an example, banks, in my opinion, one of the main themes is banks are holding their lending appetite for existing customers. So in general, because debt funds are too expensive, CMBS is up and down and driven by the market. So that's, to me, that's usually the loan of last resort. So I'm ignoring that. But well-priced debt coming from either banks or even credit unions also, but take banks, they're holding their cash and the lending appetite for existing clients. They're really not, they don't have the bandwidth to be taking on new clients, because they have some problems in their portfolio that they have to pay attention to, and they're holding it for good clients. The second factor that factors into it is which property types go in and out of favor. Unfortunately, right now, office buildings are out of favor. So almost across the board, other than maybe a Class A brand new office building that got a law firm to sign a long-term lease, or a triple net lease with a credit tenant, other than that, in general, literally office buildings are off the grid for all lenders in America. And I have had a couple deals out, portfolios. So if you're someone with an office building and you have a loan coming due, you have a problem, and that might be fine. You might have small tenants, and you don't have big risk with one major tenant that's declining, so you don't think they're going to renew. Even multi-tenant office buildings, lenders don't want to lend on them. And the opposite is the
Absolutely
good
right.
property
Let
types.
me
Multifamily, you can
pick
get
up on that.
you can get Fannie and Freddie to lend on. Hotels, I said, pre-COVID had problems, but now people are fine lending on hotels. Retail went through a bad cycle. Malls had problems. Unanchored centers had problems, but the grocery anchored centers are doing great. So it's in my opinion, it's the combination of a limited number of lenders that are putting out money, banks with different agendas at the moment, and then certain property types that are in favor and certain property types that are out of favor.
You're absolutely right, Andrew. Well said.
So property types, you mentioned a few, storage, you mentioned student housing. I met Ken Horn from Alchemy 2 weeks ago, and he's a big developer here. He built the Woolworth and many other properties here in Manhattan. He's not building here right now. They are all cash. They build and develop with their own money. He's looking in he's looking at Kansas City for workforce housing. So tell me about that shift and where the opportunities are
Sure.
and what types of property make sense.
Sure. We do a lot of workforce housing. We believe in it. I mean, because PACE Equity, is a public-private partnership, for property assessed clean energy. We believe in ESG. We think that's happening, environmental, social, and governance. So we see that workforce housing is a perfect real estate play for multifamily. We're in the middle of multiple deals right now throughout Southern California and the Midwest and the East Coast, where you've got market rate rents being built on brand new properties, and you've got 20% workforce housing. Because the large developers are moving to secondary and tertiary cities, they're doing extremely well because the MSAs are really high. Storage being one of them and multifamily being one of them. So those two asset classes clearly are winners in the secondary and tertiary markets. There is just not enough storage, and storage is getting very cheap capital from the pension plans because they use storage as, 15 and 30-year money. And then multifamily with 15 to 20% workforce housing is getting terrific flows of capital because the family offices that are very ESG, again, environmental, social, and governance oriented, are putting up money because they believe in that type of workforce housing to market housing. So those are just two areas that PACE Equity is doing a very good job lending to in capital because we believe of the growth factor. The growth factor is enormous for those two areas.
What I can add is I'm just going to pick a couple, to me, property types that are in favor because of demand for them. So to me, grocery anchored retail, people are still going to live in the suburbs, whether it's in a single family home or a multifamily, and the grocery anchored center, didn't really suffer that bad when we had change in retail, and I think will continue to do well and is doing well. Storage is doing
Like Whole
well.
Foods, yeah.
Medical
Like a Whole
office,
Foods.
medical office. I've always described that as being a sticky tenant. Once a medical practice has their location and people are used to coming to their location, they don't want to move. And it's it's a sticky tenant. That's what you want as a landlord. You want a sticky tenant where the tenant is not going to hire a tenant rep broker and try to look at their alternatives. Medical office, they typically stay. And then I'd say this last mile industrial. Amazon and all the trends that have happened with supply chain. I think last mile industrial is a great property type.
Fantastic. Marty, how are we doing on time?
You got about 5 minutes, but I have plenty of questions if you have any.
Yeah, why don't we move on to questions?
Anybody in the audience have questions? I have a question for Matt Kester. So Matt, just because you're from California, it's not like going to make you the single person responsible for all of California's policies, but I'm putting you on the line right now. I think we had a panel last week in San Francisco. I can't remember who moderated it, but so we have
I did.
People were saying, there you go. People were saying that Gavin Newsom has made rent control this policy in the state at this point in time, and that they're anticipating that if he became president, he would do it nationally. Can you talk about like the stickiness of some of these policies in California and how they stop real estate building? Just to get back to the facts, California's land, 52% is owned by the federal government and the state government. Right? That's, I mean, so you can't get building permits because the state's not selling you the land, right? Any thoughts?
That's true. Yeah, lots of thoughts. When you think about government, you think about real estate. It should be a separation of powers, right? They tend to move into areas that they don't understand. People are, taking positions in office and making, decisions that are really affecting the commercial real estate market heavily. There are tickets from San Francisco down to Los Angeles to San Diego, multifamily that can't raise their rents because there's a rent moratorium. I mean, COVID for the last 3 years has just been a bane in all the existence of multifamily owners because they would not lift the ability of an individual that's in an apartment to be thrown out. And as a result of that, they weren't paying rent, and then the individual property owner is going into either default or he's losing tremendous equity in his own portfolio because can't make the payments of an individual who's no longer paying their rent and it becomes contagious. So government, here in California, I'm sorry.
Just keep on
Government in California, tends to be, in the favor of obviously the individual, but the expense of commercial real estate, the expense of, multifamily, because multifamily is so needed. The amount of space needed in California is unbelievable. They could build consistently, but again, they're being stopped by policies, whether it's state, local, or county, to the detriment of a lot of commercial real estate owners. A few changes, and one of them obviously being rent restrictions, in terms of rent ceilings, would increase the building of more homes throughout Los Angeles, and the surrounding suburbs. So again, it's just a government issue in terms of just locking up that institutional buyer builder, result of some of the policies in the state. Those handcuffs come off. California cranes would be visible for miles in every major and minor city in the state.
Right, and I think that the government policy, and correct me if I'm wrong, Robert, but ADUs are now becoming policy in New York also.
It works in New York, but
I think ADUs
I
are
can't
now
wait.
becoming the
I can't
policy
wait.
in New York, Connecticut, throughout New England, Massachusetts, I think also. So I think that's spreading from California too.
California,
Right, that's where it originated.
ADUs are becoming very smart. People are building them very quickly on their properties. I mean, an extra tenant bringing an extra $1,200 to $3,500 a month is a big benefit to a homeowner. So ADUs are becoming very, very popular throughout the state.
But it also kind of it changes the nature of the area where they're being built, because now all of a sudden single family becomes
That is
multifamily.
correct.
Right. So,
Correct.
but I'm just saying, just from a from a policy point of view, there's a reason why people are building in Florida, where the state and federal government own far less land than in California or Oregon, right? Or 70% of Oregon's land is owned by the state and federal government, which is why right outside of Portland, there's this massive state park where homeless people live, right? There's thousands of homeless people living in this state park in Oregon, right? So,
Right. And because, the rates are locked and lenders aren't lending, Pace Equity, our firm, we're doing a tremendous amount of lending, and we're doing it with a 7 or 8 handle, because, this is 30-year money. There's, no prepayment penalties, are strict. And again, the owner himself, if he is leaving the property, he's welcome to, transfer that loan to the new lender, to the new owner. So when you have something that, is fixed rate and long-term and non-recourse, that grows the market. But if the state or the city sits on top of you and negates that, it becomes a problem. But again, there is
Matt.
money out there, just in pockets.
Matt, Pace Equity has $1.5 billion to lend. What's the lending gap?
Correct.
I mean, there's a lot more coming due, right? It's like $1 trillion or trillions.
Yeah, well, this is, we're doing it on new construction. We're also doing it on rehab. So we'll take a 3-year look back and, help you with those costs that you put into the property. Or if you're building a property, our dry capital going forward is at a reduced rate. And what's nice about it is that, the actual owner of that property is just paying his taxes each and every year. It's a property assessment tax. So that property assessment tax comes from the state and they pay the state. So for us, we're just providing the equity that the state uses for tax benefits to grow the infrastructure and to grow, schools and to grow, just the surrounding communities for the taxes that they need. So PACE equity or a PACE loan is very good for the community because it gathers taxes. And that's again how an individual borrower would borrow from PACE. He's directly borrowing from us, but paying it back through a state assessed property tax. And that
What
again is
percent of
great for
loans
the
get
environment.
approved?
It's great for ESG.
Matt, what percent of loans get approved?
If we put out a commitment letter, your loan is approved. If you put a commitment letter out and you're signing and you're making a deposit, it is approved.
How many commitment letters do you put out as a percent of applications?
Well, we put out probably 15 to 30 term sheets, on a regular basis. Then we do, another 2 to 3 weeks of due diligence. If at that point that we're gone through the due diligence and we're ready to go to commitment letter, those commitment letters are 100% funded. There has been, no turn back of commitment letters. Once we've made that commitment to place those monies, that loan is funded.
Andrew, any thoughts on alternative credit outside of PACE?
Yeah, again, and the complication I've had with PACE, I'm going to follow up with that afterward, is you have to marry up the PACE with the construction lender or the senior lender, so they have to get along nicely. But yeah, the alternatives are Brownlee's Capital, again, is turning it upside down. I like to tell people, if you look at preferred equity, so if your senior debt is at 60% loan to cost, you can always add preferred equity. So that can maybe go from the 60% strike point up to maybe 85%. So preferred equity is going to be, 12 to 15%. If you do a ground lease deal and you turn it upside down, you can bring in the ground lease capital at a lower cost of capital and then add the senior debt on top of it and end up at the same 85%, but at a lower blended cost of capital. But answer your question, Marty, it's preferred equity, preferred equity or mezzanine are the same thing. Just who is your senior lender and how do they want it structured? So those are the two most commonly used. And there's a ton of it out there. I mean, I listened to one of the panels yesterday and people were questioning whether preferred equity is available. There's an enormous amount of preferred equity available. Most of the LP equities, so the Carlyle groups and the Angelo Gordons, they're really sitting on the sideline. And when I have a deal and I call them, they very quickly pivot to, Andy, yeah, we love this deal. We're not really putting out pari passu common equity now, but we'll do pref. So there is an oversupply of preferred equity. The problem is you got to look at the deal carefully. And if you're the sponsor and the preferred equity is taking you to 85% of the stack, then you got to scratch your head and say, okay, so where am I coming up with the other 15%? And if God forbid the property doesn't progress well, it's a multifamily, it leases up slowly. There's a construction issue, so it's delayed. The preferred equity is accruing and accruing and accruing, and that's going to hurt the common equity guy.
What's the 30 seconds? What's the average LTV that you're seeing right now in deals?
The average loan to cost on development deals is 55.
Okay.
You can get senior debt to go to 75, 80% loan to value, but it's brutally expensive and extremely low risk.
By brutally expensive, you mean what?
13%,
25?
Double digits.
And
Okay.
Marty, and
Matt?
that's why PACE equity fits beautifully into a stack like that. We're go up to 30% of a capital stack. So it can be accretive to not only the growth of the property, but in the balance sheet, we can take a 15, 20, 25, up to 30% of that capital stack position can go into PACE, lower your cost of funds. That is something that people use over and over with PACE because of the other types of, debt and equity is so expensive.
Fantastic. Great job, guys. Thanks so much.
Thank you for having us.
Let's